Hi everybody, it's Jeff Fitzpatrick and this is Thursday the 9th of September. We held the first Sapphire meeting last night and the recording is part of this. However, the meeting went on for 2 hours. So what I'm doing is going through the summary of what actually happened at the meeting. Following this, you'll see a couple of examples of the trades that we did, and all the trades are listed on the document you can see now. And then I've edited out most of the trades after that, but I've left in the discussion and the questions. So if you want to go through the whole thing and hear the questions and the answers, that's absolutely fine, or you can just take it with this summary. For the sake of the record, I have retained the video recording of the full meeting so that all of the trading decisions and outcomes of the trades and the agreements to place the trades are recorded. And this is how we ended up at the end of the trading last night. The stocks that we sold puts in are listed with AU at the top, they're alphabetical, and on here you can see we're not currently in profit, they haven't actually moved very much yet, apart from CCL, which we did the day before, which is 1.03% in profit already. And the average open price is the put premium that we got per share for the number of shares that we sold the puts on, which is under quantity. On the top line AU, that's 5, which is 500. The box to the left is a summary of where we are on the account. So we have sent $190,000, there's actually about $190,500 to the account, but the cash in the account is now $225,718. So the difference, which is about $35,200, is the premium income that we generated during the course of the meeting last night. And that's about 18.5%. So obviously it's pretty good, and we will be doing this all of the time. We've got a lot more trades to do yet, a lot more cash to generate yet, and we want these spread over months to come so that cash or profit reservoir is actually throwing money out, throwing gains for us in each month. That will take 2 or 3 months to get into action, but thereafter it should be a continuous stream. Another important figure in that box is the stock buying power, which you can see is at 318,000, almost 700. We keep our eye on that, and we never wanted to go below half of the value which is shown as the net liquid value of the account. So that means we've actually got around $223,000 of stock buying power. That's a huge amount of money, and it's going to allow us to do a lot of very lucrative trades. So last night we worked down this list and we went from the top there, CCL, and we got as far down as row 18, NEM, which is Newmont Mining, the largest gold mining company in the world. That's as far as we got. We've still got about 8 trades to look at, which I'll look at during the course of today. So going across, in column A are the stocks that we've traded. In column B, these are scores that we've put together on some of the companies. The higher the better. Anything that scores above a 40 is very good. The price is the price at the close of business yesterday. The forecast is where we expect the price to get to, and the percentage is the next column, column E. Then F and G are what value line think the stock price will get to in the next 18 months to in column F, and in the next 3 to 5 years in column G. Then you've got the risk and reward. Just a visual check whether it's low, medium or high. We try to keep away from high risk to reward stocks, obviously. Then we got the price that we sold the put at, the strike price. So each of those is a promise. So we have promised, for example, to buy CCL, which is Carnival Cruise Line, stock for $32.50. Anytime up to the 3rd Friday in January, that's the month. We have placed a limit order to try to buy the right to sell those shares if they're put to us, again at $30. That is to release stock buying power and also to give some protection. You can see the target premium on this one was $10.05. We actually only managed to get $9.75, but if you look down the list, most of them we actually got well above the target. Then we've got the cost of putting that protective trade in place, which is 10% of the strike price, the estimate of the stock buying power that it uses, and the outcomes in percentages that we've got. The last column, column T, shows the number of contracts, that's batches of 100 shares, that we would need to buy at the strike price in order to get about $10,000 worth of stock. We look at $10,000 worth of stock because the account is worth about $200,000, and we would look to have 5% stock holding in each of the trades that we're in. So that's it for now, but as I say, we'll follow on with some examples of trades and the discussion that took place. Thanks to those that attended and to those who are watching this. So I managed to get hold of the trade desk in New York last night and get the account switched to be able to trade the options. And as part of that, I had the guy hang on while I actually did the first trade, just to make sure that it was all working correctly, and it was. So we have sold the Carnival Cruise Line January 22, $32.50 put, and we got $9.75 for it. And you can see the last price was actually $9.65, so we did a little better than that. The quantity was 200, so there are 200 shares. Now, the negatives on this, whenever we sell a put, we're selling something, so we're getting money in, but it shows on here as a negative until we realize the profit on it. So unfortunately, well, fortunately and unfortunately, there's more money gone into the account today, which has took it up to this 190,000. But you'll notice that the net market value is lower than the cash value. And that difference is basically the income that we got for selling this put. And that's sort of $2,000. So that's our first $2,000 under our belt. For every one that we sell, I then go in and put a protective order in, and I'll show you that. Here we go, close. So we have offered to, so that the first one that we sold was the right for somebody to put these shares to us at $32.50. And what we've done is used basically 90 cents I used out of the $9.75 to offer to buy the right to sell them again at $30. Now that may or may not click in. It will only click in if the price to buy that right comes down to 90 cents, which as the price of the stock goes up and time elapses, most of them will, but there's certainly no guarantee of it. So for everyone we put on, if I don't remember to do it, someone has to remind me to put the, we call it the lid on it. So we put a lid on the trade in terms of what it can lose. So yes, so sorry, these are the trades we're going to look at tonight. CCL at the top, the price it was when we did the research, where we think it's going to get to, the increase percentage. Now these are the value line, what their opinion is. So they're saying they think in 18 months it will stay at around 24, but over the longer term, 3 to 5 years, it should get up to 40. The risk to reward is just my visual assessment, and I'm saying that it's got a relatively low risk to reward on it. The strike prices that I had to go to, I couldn't go for 31 because there isn't one at 31. It's 32.50 was the nearest, so I went for that one. It expires in January. The lid strike price that I put on was underneath it is $30. The premium target was $10.05, and we actually got $9.58. But it got more than that earlier in the day. The lid cost, what the net premium is. So if we have to buy the lid and then sort of they're sold again, even in that circumstance, we would make $6.10 per share. SBP stands for stock buying power. And we've got a huge amount now. We've got nearly 100,000 of stock buying power. And if we sell one contract of this put, that's an estimate of what it will take from our buying power. And then we've got, if it isn't put to us, we should make 18%. And if it is put to us, we should make 51%. That is a percentage of the buying power that it's used up. But what we're hoping to do is to make basically 18 and 19% on this. So that's what we're doing. So the next one in line, and they are ranked in terms of these at the end here, sort of 18 down to 8. We probably won't get it down as far as 8. So the next one is AU, which is not AU, Jimmy, it's AU, which is a Anglo-American Gold. It's a gold mining company. And we'll look at the chart. And so we're looking to sell 5 contracts of it. And we want to use a strike price of 21. And very good is the fact that the lid is only $1 less. The one above you can see is $2.50. So if we have to buy it for $32.50 and sell it for $30, that's $2.50 out of our profit. Whereas on this one, if we have to buy for 21 and sell it for 20, that's only $1 out. So the lower that difference, the happier we are. And I want to try and get about $5.10 for each of the shares in this. Okay, so this is Anglo-American Gold. And so we're looking for this to get to $21. Oh yeah, so this one, I'm going right out to April. And that's because mining stocks are slow movers. So it's at 15, coming up to $16 now. And we want to get it to just here, 21. Yeah, so we're not asking much of this. We're saying, oh, look, we know you go that far. Compared to where it's been up here at $38, in the past up here at $48, we're only looking for this to get to $21. And it's been at that level lots and lots of times before. The indicators, again, below the line going up, under the line ready to turn, and on the line ready to go under and come up. So we're giving it plenty of time, and we shouldn't have any trouble with it. I'm only prepared to do this because we have got a huge amount of buying power that we're probably not going to use all of it. So we might as well go for a long-term one and start building up the pipeline for later in the year. Back to the trading screen, and we go to trading, symboling, which is AU, and we're going to add an option. And now there are 4 things we can do here. The one we want is sell to open. We're selling an option and we're opening a trade with it. So that is a sell to open. We want 500 shares. So for options, that means 5. Expiry was April, and the strike price was 21, and it is a put option. So what we now get is 580 by 610. So we've got a price, and I'll go back to that in a moment. I want a limit order. So the price looks good. We were looking for the target was less than that. The target was $5.10. So we should be well happy with this, but we will still try and negotiate. So there's $5.80 that we expect to get for it on these prices. If we were buying it, if we were selling it, we get the lower price. If we're buying it, we have to pay the higher price. That's how it is. So I'm going to try, first of all, for $5.90. So they're saying $5.80, and I'm saying, oh, go on, give us a bit more. Now, we may not get it, but it's always worth a try. Now, when I click on here, I see the actual real prices. The prices on here up before that are delayed, and it's 580 by 6. So we probably won't get our 590, but we will still try. If we do get it, we should get proceeds of $2,950. We will lose $15, $14.95 will be the cost of the trade. So that brings the proceeds down to $2,935. And the total cost is this 1,900, and we call that 1,200. And we have to double that to get an estimate. So this is likely to cost us about 2,000, call it $4,000 in buying power. So we now press on trade, get the modified one at the top. So here is the trade that we're doing. I'm going to go this little circle here, and I'm going to take this down to 580. And so we've got it. So we've got it at 580. So proceeds 2,900, less a little bit of commission for the broker, 2,885. So when we go back to look at the summary page at the front, our cash will have gone up by nearly 2,900. But what do I have to do next? I have to put the protective trade in. So I'll take you through that. So back to here, but this time we're looking to buy the right to put these shares to somebody. Not at the same price we bought them. We go one strike price down, so that's 20. And we only want to pay 10% or so of what we got in to do that. So that's going to be 60 cents, call it 60 cents. And I put a little note in the comment box to say it's a lid. Next I press the verify. We're not really interested. These are what it would cost us to buy or sell that option at the moment, but we are not doing that. We're putting a limit order in, which means that this will sit on the system and will only trigger if and when the price gets down to our 60 cents. So we don't want that to be filled just yet. There we go. And so if we go back to orders, we've got the first one, which is filled, and this new one, $1 down, which is a new order. So we're done with that. Go back to the portfolio. You can see that the cash has gone up again. Our net liquid value hasn't moved. So we basically haven't used any money yet, and we're not planning to. So we're not borrowing money. We're not using our own money. We're just selling something. It's how it is. Okay, so the next one's exciting. You'll like this, or possibly not. LVS, which is Las Vegas Sands. And it's currently at about 43. We'll see what it actually is at the moment. We think it's going to go up to $60. And Value Line think it's going to go up to $80 in the next 18 months, and even higher to $86 over the next 3 to 5 years. It's got a low risk to reward score on it. And we're going to look at not saying, okay, we want to go all the way up to 60 or all the way up to 80. We're going to go for 55 and January. The lid will be $2.50 underneath that. And we're looking for a big premium on this, $12.45. And we need a big premium on it because we've got to, first of all, give $2.50 back there. So that would leave us with $10, less this one here. Would end up with about $9. So LVS 60, we're going to do 2 contracts, and we're looking at January, and we want $12.45. This would normally take me about half an hour to do all of them. So anyone want to shout out what we're doing? Sell to open?
Sell to open, yeah.
How many contracts was it?
2, wasn't it?
How many shares does that mean?
200.
It does indeed. January, and the strike price? 55.
Yeah.
What type of option is it?
Put.
It's a put. Okie dokie. We don't want limit order. We want a market order. So we were looking for $2.45. Okay, so we put the price, the limit price in there. So they can't sell this to us for less than the price that's in that box. Verify it. And we see that the current prices are $2 by $12.30 by $12.40. So we're not likely to get our 45. But being a bugger, I'm going to try anyway. No. So back to orders. Here it is, little circle. Now, some of these go up in $5, 5 cent intervals, some in 10, and there are even some that go up in 1. This one goes up in $5 intervals. So we'll try now for $12.50. So I'm just going to keep going down in 5 cent intervals, until we get there. It's still well worth doing, even if it gets to 220. Okay, so we've got it. So the price they're showing is 225. We've got 230. That, I like that. Those 5 cents all add up to help pay for the broker's fees. So we're going to add another 2,000, nearly 450 to our cash here. So we need to remember that price now, $12.30, because we're going to go back to the trading, and we're going to buy to open on a limit order again. One strike price down, 52.50. It's still a put, but we only want to pay, we'll go 120, $1.20. Not quite 10%, but there we are. And there you go. So that's its protective trade in place. Okay.
While you're doing that, can I ask a question?
Yeah, please do.
How do you, on that spreadsheet that you manage yourself, how do you get updated market prices in, and how often do you do that?
Well, I normally do it. Well, I do it over the weekend. So once the market has closed, I've got from Friday night until Monday afternoon. So yeah, I've got plenty of time to actually do them in there. So I always fully update everything over the weekend. And what I do then is I might put them all up and go through them all again. But basically what I do is just look at the chart at the time that I'm trading it. I've been through all of the charts, not just the ones on that list today, but I've been through about 150 charts, looking at them, just making sure that nothing has gone wildly up or down. So that's what I tend to do.
By the way, Jeff, that spreadsheet at the moment is quite manual because you're obviously going in and doing it. Are you able to put some formulas in that will tip you off if you get certain conditions are met, like kind of conditional formatting, so that?
Not on the spreadsheet, because the spreadsheet's not connected to a feed, but I can put them on the trading platform. So yes, we can get two types of things. One, we can get alerts, so we can get an email sent if something hits a price that we want to know about it, and or we are putting in a limit order which says if the price gets to whatever the limit is while we're doing something else, please do that trade. And there is some degree of conditionality, where you can actually say, well, if this price goes to that and that price goes to the other price, then do something else. But it's not like Forex trading, which was a lot more, you do a lot more conditionality on it.
I think that lid you just put on there, was it limit price rather than market? Was it market that you wanted on that?
No, limit.
It is
Definitely
limit.
limit.
Okay,
Yeah.
sorry, apologies.
Yeah. When we finish, I'll set this so that it automatically goes to limit. Basically, every order we do will normally be a limit order. If you put market orders in, the brokers can do what they like. They can temporarily reduce the price or increase the price, whichever, and charge you it. So we don't trust brokers, not that much. Okay, so there aren't many ETFs that we follow. There are, in fact, only 3, and we follow those 3 because they're in sectors where we follow quite a lot of stocks anyway, so we've got a good idea of what's going on. This one, which is mining stocks, and it tends to be smaller companies in the mining sector. So it's a way of us investing in a group of smaller companies or trading with a group of smaller companies. Another one is called JETS, Jets, and that's airlines, and they're from all over the world. It's a big group of airlines as an ETF, and I don't trade that one. I just don't think that the airline industry is ready yet for trading until we get further through the pandemic. And the other one that we look at is the oil ETF. And we don't tend to trade it. We tend to look at it and get an idea. It's usually a good indicator of where the rest of the oil industry is headed.
Right.
But we're not averse to ETFs. They've just got to pass the same filters and tests as everything else. See who's next.
You've got quite an interesting, I was going to say, sorry, you've got quite an interesting spread of shares as well. Like you're not heavily into one sector or market, really, are you, with that?
Well, we try not to be. So we only if we're going to own shares, we only want one share in each sector. So one in education, one in pharmaceuticals, one in oil, and so on, and then not necessarily every sector. However, because we only get sort of 80% of these things put to us anyway, we are happy to say, well, okay, then we can have more than one put running in a particular sector. And you'll find when we get up to full speed, we'll probably have 50, 60 puts running at any one time. And that will mean that we have to overlap on the sectors. However, there will be different companies, different strike prices, different expiration dates, and so on. And if we're already in, for example, if we're already in Occidental or something oil, then we wouldn't allow ourselves to be put into BP as well.
Okay.
But yeah, we would actually run out of good trades. So we are taking the view that we're not actually buying these stocks. In most cases, we never buy them, we never see them. So we're prepared to be less diversified.
Do you find, Jeff, that most of the lids trigger whether you're going for 8, 9, or 10%? Because I've noticed tonight you kind of go slightly less than 10% most of the lids. If in doubt, go beneath.
There's two reasons for the trigger, and I only like one of them really. The lid trades. So lid trades tend to trigger, in my view, too late to be of any use. So the price of the stock, so if we did like any of these Disca 35, and we've set the trigger just below that, let's say it was 34, the lid won't trigger until we get up there above 34 anyway. So yes, it's good if the price then goes up and comes back down again, we're well protected. But if the price just goes up, in that respect, we tend to have wasted our money on the lid. However, the other big thing that it does is it gives us buying power, stock buying power. So what the market does is says, oh, well, at the moment, we have a risk on Disca of $35 times 300.
Yeah.
So that's what we would have to spend if these shares were put to us.
Yeah.
If the lid has triggered, then our risk is only now, if that was $1 intervals, is only $1. So it's $34 against 35. So they will then give us $34 worth times 4 of buying power back.
Yeah.
So my main reason for putting lids on is to get back buying power. It has a secondary, for me, advantage of helping in being, a safety device. Yeah.
What, as to how this spreadsheet has arrived, is this basically a summary of your research and preparation and action plan in order to
Yes.
actually execute specific, trades on each share.
Yes, it is. I'm going to go. I'll take you back to and share the charts. Okay, so all of these stocks on the left-hand side are currently they pass the automatic filters that we place. Okay. So they are all reasonable candidates. They're all sound companies. So there are something like 30,000 companies that you can trade, and Value Line only look at 1,700. We narrow that down to this, which is there's like 130 or something here. It does go up and down, but 130, 140 companies. And then we're looking like this. So this is an example. EDU, we're saying, okay, then we'll like the look of the chart. We'll like the fact that it's at a low point, and it can't even go much lower. We'll like the fact that the indicators are moving in the right direction, all three of them in this case. We then look at the Value Line reports and get somebody else's opinion on the company and where it's going. And from that, we also take their opinions on the share price as it will be in 18 months and in 3 to 5 years. If we like all of those things, I then go put them on my spreadsheet. So I stop showing this, and we'll go back to the spreadsheet. Here it is. And so I've now got, if we take the top one here, I've got what we think's the current price, where we think it's going to get to, where Value Line think it's going to get to. I've also, from looking at the charts, made it's literally a low, medium, or high. Got rid of all the high ones. So anything that had a high risk to reward ratio, I've taken off the list. Not interested. Similarly, anything where the increase in the price isn't, reasonable. I've let one through there at 14% PRGO, but it's way down towards the bottom of our priority anyway. So we may not actually do it when we get there. I must think the chart looks very good. There must be a reason for it. I've then looked at where we expect to get it at the price to, where it is now, and determined whether there is a suitable strike price for us to go after. I've then looked at the chart again for the steepness of the curves on it to say, well, okay, if it moves in its normal character, how long will it take to get to these prices? So that's allowed me to determine the month. I've then looked at the lids, these are the protective trades, and some of them, well, from that, I've then sort of worked out a premium target and the cost of the lid, and sort of said, is it worth it? So a lot of them, where there's a $5 interval between the strike price and the support price underneath it, I've taken out. If it was like $9 and 5 of them were going to go in that lid, then I've taken it off the list. So then I end up with these. Well, the next column is I'm looking at the amount of stock buying power it's going to use, and if that's too high, I'll take it off the list. I'm also looking at what we can expect to achieve in profit from it, and I've got it ranked on those. So as we go down this list, I get less and less interested. So again, we probably won't make it to the bottom. Certainly below 8%, I'm definitely not interested. And I've looked at that both for if the stock is put to us and if the stock is not put to us, and I rank them both. If the stock's not put to us, that's when we do best. So I've allowed these couple of low ones in because if the stock is put to us, it's still pretty high. So okay, if we get down there and I'm still looking for trades, I'll go with them.
Right. So the list that we're looking at on this spreadsheet is because you've gone through those 130.
I've gone through them, and my partner in crime, Owen O'Malley, has gone through them. And a couple of senior traders have also gone through them. And we've got our heads together on them and sort of compared lists and compared reasoning and ended up with a list.
Yeah. So how often and why might a share literally drop off your list completely?
Oh, you mean not even be on as a candidate?
Yeah. Not make it to your spreadsheet.
It will.
Oh, sorry, no, I meant once it's on your spreadsheet, can circumstances, mean that it would drop off?
Oh, every week.
You would.
Yeah.
Right. Yeah.
I don't know. I don't know if you'll see this. If I change that screen, can you see a different screen now?
Yeah.
Right. If I go right across here, where do I want to be? So there in column R, it was the price that it closed at the weekend, bearing in mind the market was closed on Monday, and the forecast that we arrived at, and any notes I made on it, and the percentage. So every single week, we reforecast on these stocks, and if they've gone up, for example, it might have gone up too high, so now there isn't enough growth left in it for us. So in that case, it will drop down. The percentage will drop down. So
right.
you can see some of these. It's like 1%, 5%. They're not getting anywhere near the list.
Yeah.
And if it then also all of these, we're going right down here, have been looked at on Friday and haven't made it. Either we're not forecasting enough of an increase, or we're not forecasting an increase at all. And then the actual list itself, who gets onto that candidate list, that's revised every week. So every week we're running the filters to renew this list.
Right. Okay.
So there's
that's a lot of background, isn't it?
Oh yeah. There must be. I mean, bearing in mind when we look at the filters, we're looking at about 24 different parameters.
Yeah.
The price to earnings ratio, the level of debt, how many years they've gone in profit, been in profit, the profit growth, the sales growth, the ability of the management team to forecast correctly what's going on with their profits, all sorts of things. Yeah. So by the time we've actually finished with this, I would estimate, I've never counted them, we've probably got about 40 parameters that they've actually got through. And nobody stays on the list for more than a week. They've got to make that every week. Yeah. That's why I do it over the weekend, because it takes me ages.
Well, I mean, we appreciate that for sure. Okay.
But the other thing is, I mean, it's not infallible, and people come up with good ideas. I mean, I get people all the time. Have you done this? Have you done that? I just sort of say no. And even if weeks later they say, "Oh, you should have done it. It went up. Whatever it went up." The fact is that we are only interested in stocks that meet the parameters. If they don't, we're not interested.
Okay.
So, for example, I mean, like Tesla, Facebook, all those lot, we wouldn't touch them with a barge pole because they're overpriced. Right. And when we say overpriced, what we're looking at is how close the price is. It doesn't matter what's expensive. Not whether it's $900 a share, doesn't matter. What we're interested in is how close to the book value of the company is the price.
Right. Okay.
Yeah. Because we know from experience that companies will generally get to at least around the price of their book value. Why wouldn't they? That's what they're worth.
Right. Yeah. Okay.
So there's a huge amount goes into it. Yeah. All of which you can enjoy if you want to do all the training.
I was just going to say, it's a totally different strategy for those people that trade on Facebook and Google and Tesla and Alphabet and so on, isn't it? They're doing things for different reasons.
Yes, they are. Yeah. You've got to bear in mind that 95% of the people who trade have no experience, no training, and no strategy.
Absolutely.
They're buying Google and Tesla and Facebook because they've read about it in the paper. And I can guarantee that that is old news.
Yeah.
There are some professionals who will trade in them.
That's what I was that's what I was getting at, Jeff. There are some professionals who know what they're doing.
So for example, but the problem for them is that we're buying or selling rather the max. Well, we did 11 contracts on Edu. Other than that, it's been ones, twos, the odd 5. If you try to do what we're doing and you are some hedge fund, you're going to be in serious trouble. You will stick out like a sore thumb on the what's called open interest. The brokers will know, they will actually see that this client is one client and they will go after them. They will make sure that come expiration day, the price is the wrong side of the line.
Yeah.
It's one reason why we have different clubs, so that we can grow them to quite a good level. But the brokers can't actually see that, you know, we may be trading the same put, but on different accounts.
Yeah.
We don't trade all the same ones on the same accounts, but some are very common and we do.
Yeah. Right.
That all makes sense, Jeff.
What normally happens is I will still do this, even if it's not tonight, it might be tomorrow.
Okay.
Or it might be the next day. So I'm looking at prices and sort of saying, well, is there a better trade than that one to do, and so on.
Yeah.
So in between meetings, if I see any fantastic opportunities, I will normally put something in the WhatsApp and say, oh, look, I'm looking at this.
Okay.
And if anybody then wants to engage with me and discuss it, that's fine. If they don't, as usual, then that's fine too. I'll just go and do it. And you normally have to be pretty quick. But I try and leave. So we will then have the club meeting in the week leading up to expiration. And going forward, once we've got started beyond tonight, that's when most trades take place. So we'll be looking at what's due to expire and deciding, do we need to take any action? If so, what are the alternatives? What are the numbers around each of those alternatives? Which one do we want to do? Or do we want to wait it out? Or do we want to leave it in my hands until the Friday evening when they expire, when I go through and just check that everything's in order? So that's how it will work sort of going forward.
I don't understand it about expiration, because we're doing trades of various durations. So your expirations are share specific throughout. So help me understand that expiration.
Yeah. Well, let's just I'll just go back to the trading screen and the portfolio, which is nearly 126,000 now. Yeah. Right. So what we've got here, and what I keep my eye on, is the days left.
Okay. Yes.
All right. So the days left, the first ones we've currently got expiring. We might end up with some October ones, but the current earliest ones are November.
Yeah.
So in the November meeting, just before, a few days before, we will concentrate on these ones that are currently 72 days. Then in December, it'll be the December ones and so on.
Yeah. Right. So it's just every month, pick those that are relevant.
Yes, we'll look at the others, but we'll concentrate on the ones that are due to expire.
Okay.
And then at some point, we'll probably end up owning shares. Some of these shares will get put to us. So we'll also be looking at them with a view to saying, well, we own this share. What should we do with it? Yeah. Do we sell it? Do we sell it and then take another put out on it? Or do we sell a call on it? And we'll make those decisions at the club meeting normally as well.
Yeah.
Except I look at it most days, and if there's suddenly a vast amount of money available, I'll take it.
Yeah. Okay. Fab. Okay.
Jeff, can I ask a question around that?
Yeah.
If we get shares put to us, would it, and let's say it's in January, and that company's, or no, maybe December, say, whatever, any month, right? And that company's dividends being paid the following quarter. would you be tempted to hold on to the share till we have it on next dividend date? Is that ever a consideration?
No, not really. There's very few of the shares give huge dividends. One of our parameters is dividends. We don't like them giving dividends out. We want them to reinvest the money.
Right,
But we are watching for results days because the prices can go all over when results are announced, and we don't know whether the results are going to be good, bad, or indifferent. And once we own stock, we have got things we can do. So let's say we owned any of these. We own GT and we paid $21 for it. We might well say, well, okay then, and the price is currently around that. Let's sell someone the right to buy it offers for $22. And they might give us 50 cents or something for that. So we would potentially look at that versus how much the dividend is forecast to be and say, no, just hang on, we'll have the dividend. So, I mean, we definitely do get dividends, but we don't chase them.
Sure. Okay, cool.
Right.
Yeah.
Right.
It's our fourth income stream. So we've got selling calls, selling puts, selling stocks or price appreciation on stocks, and dividends.
Right.
Yeah.
Okay.
But selling in order, selling puts is more lucrative than selling calls, isn't it, Jeff?
Definitely, yes, yeah. And I mean, selling shares, owning a share, letting its price appreciate, can go up by a lot, obviously, but we tend not to hold them, so we would jump in and out because the stock won't go up in a straight line. It'll go up and down. So we would say, right, it's at a short-term peak. Short-term peak, sell a call, let it come down again. If it gets taken off, it's fine. We buy it when it goes down again. Back in, at the next peak, sell another call, and so on. So by the time it's gone up, we've perhaps sold several calls on it. And sometimes that can go on for months, and we've had more in call income than the actual value of the stock.